It's hard to say exactly what's going to go wrong, but something definitely is. And whatever it is and however it manifests itself is going to lead to the final round of printing. And that is when gold and silver are going to explode. It's going to be quick. It's going to be overnight. I don't know how much overnight, but it's not going to last very long once the final printing round gets started. And when exactly will it get started? I don't know, but it's going to be sometime close to when the RRPs run out, which will be in the next few months. My view is March. The Fed's view is June. It doesn't really matter when. It's coming. Everyone knows it, but nobody at the Fed really knows what's going to happen when it hits. Neither do I, but I'm closer to the truth than they are.
The Fed will continue to print 30 billion US dollars till March. The target rate is now 0.25%. The Fed under Jerome Powell has fired the worst inflation since the 1970s Great Inflation, which came after the collapse of the Bretton Woods gold peg. Gold outperformed most traded commodities in the current year in international markets, with prospects for the next year also looking firm. We anticipate gold to witness fresh all-time highs in 2024, with $2,250 still achievable in the first half of 2024. Global financial analyst Rafi Farber predicts a crisis with rapid money printing, anticipating a swift rise in gold and silver prices, possibly in March. The M2 money supply measure has increased slightly since April 2023. In addition, the monetary base, consisting of bank reserves and currency in circulation, has increased over 7% since March 2023. This is the primary reason why the price of gold ran from $1,925 in March to $2,070 by year-end 2023. However, Rafi highlights the gold to GNX ratio, signaling gold outperformance, while he notes a short-term struggle in gold and silver, attributing them to a broader commodity trend. Indeed, gold rose by a hefty 15% across 2023 to hit a final trading day record of $2,078 per ounce on December 28, positioning it near the top of the year's best-performing assets. Earlier this month, the bullion reached an all-time intraday high of $2,135, stating a strong bullish trend. Many anticipate this momentum to persist through much of 2024. Despite higher metal prices, Rafi notes decreasing SLV and GLD holdings, indicating waning interest in paper markets. He also highlights dwindling paper gold interest near all-time highs. The current volatility for SPDR Gold Trust GLD is 2.87%, while SLV has a volatility of 4.62%. This indicates that GLD experiences smaller price fluctuations and is considered to be less risky than SLV based on this measure. Now, we present the clips of Rafi Farber's insights from his recent video with Arcadia Economics. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
We'll begin with a quick technical note on gold here. We have the gold to GNX ratio. GNX is a production-weighted index for commodities. So we see that the gold to GNX ratio, the higher it is, the more gold is outperforming. We are staying healthily above the 200-week moving average here. We've been above the 200-week moving average since around the end of November, it looks like. I think this is week number 7 or 8. And if we look at the past in April, May, June, we did push briefly above the 200-week moving average, but couldn't stay there. But the last time we bounced off the 200-week moving average was in July 2019, which was right before the massive run to all-time highs in gold versus commodities. So it looks like gold and silver are struggling now, but really it's all commodities across the board. I think we're in another wave of dollar rushing, and that's going to get worse as the liquidity crunch comes nearer and nearer, and then it's going to become extreme. And then, of course, the Fed is going to print a whole bunch of money. And in my view, in my personal view, that should lead to the end game because it's going to be more extreme than any other time in the past, which is what happens every round of money printing is more extreme than the one before it. And this will be the last one. Could I be wrong? Yeah, this is what I think. Now moving to the silver paper markets, comparing to silver squeeze. So we see here that when silver bottomed at around $16 in September 2022, I believe it was. So we've had a gently higher trending market in silver with a little bit of a triangle action here. In the blue is the silver price, in the black is the SLV holdings. So we see here that SLV holdings kind of bottomed out over here. when silver bottomed, then went up very, very briefly, but they've been down since. We've hit a new low post silver squeeze. This is about 13,460 something tons. And it is a new post silver squeeze low. So what we've seen here is that holdings have gone down and downtrend lower and lower and lower as the price is trending higher since September 2022. So that's showing me that interest continues to wane in the paper silver market and the demand continues to be in the physical markets. We're seeing the same thing in gold here. This chart a little bit zoomed out, but if we look at GLD versus the GLD holdings, the gold price versus the GLD holdings, the blue is the gold price. And it's been trending higher also since silver bottomed. Gold and silver usually bottom together around September 2022. And now we're up significantly, but the GLD holdings keep trending down and down and down despite the rise in the gold price. Paper gold interest is also on the wane, even though the price is approaching all-time highs. Silver lease rates are doing something really weird. They are up to very near all-time highs that we last saw during the 2008 financial crisis. Why exactly this is happening, I don't know. It's something very derivative related. It means that silver futures prices are significantly above the spot price, which is making these rates higher. What exactly is causing it? If it's something in the derivative market, then something is imbalanced in the futures market and it's going to resolve itself somehow. It's hard to say exactly what's going to go wrong, but something definitely is. And whatever it is and however it manifests itself is going to lead to the final round of printing. And that is when gold and silver are going to explode. It's going to be quick. It's going to be overnight. I don't know how much overnight, but it's not going to last very long once the final printing round gets started. And when exactly will it get started? I don't know, but it's going to be sometime close to when the RRPs run out, which will be in the next few months. My view is March. The Fed's view is June. It doesn't really matter when. It's coming. Everyone knows it, but nobody at the Fed really knows what's going to happen when it hits. Neither do I, but I'm closer to the truth than they are.
Rafi Farber pointed to the Fed debate on banking reserves, noting a $1.6 trillion drop in reverse repos since May 2023. Despite expectations, the money supply is falling, raising questions about the missing funds. If these dynamics persist in the months ahead, overnight reverse repo take-up may continue to decrease. Such a steady decline would be consistent with that observed in early 2018. When investment at the own RRP gradually disappeared as the Fed continued to normalize, the size of its balance sheet and reserves in the banking system became less abundant. He mentioned John Williams backing the current QT pace, as Chris Waller downplays the significance of the reverse repo facility's contents, indicating a split in official opinions. John Williams, president of the Federal Reserve Bank of New York, said in a speech Wednesday that he doesn't expect the central bank's quantitative tightening efforts to slow down anytime soon, citing ample reserves in the banking system and continued activity in the Fed's overnight repurchase facility. Let's get back to the interview.
Into an argument that is happening at the Federal Reserve between different Federal Reserve governors concerning the ideal level of reserves in the banking system. There's some kind of alien sounding acronym for it. We'll get through that in a second. But the basic issue that these people don't understand, there is extra liquidity in the system. We know that right now as reverse repos, and they are down about $1.6 trillion since May 2023. Now, in that time, you would expect the money supply, all other things being equal, to rise by about $1.6 trillion because you have money that was not in the monetary system, that was in the reverse repo facility, which is not counted as part of the money supply. You have that pouring into the banking system through the purchase of treasury bills, and yet the money supply is still falling. So what happened to those $1.6 trillion? Where are they? Where have they gone? The answer is they have gone into the monetary system. And to counteract that, we've had debt repayment and defaulting due to high interest rates. When debt is repaid, that is money on the other side, becomes annihilated and gets erased from the monetary system. Because the money supply has been gently falling ever since April 2022, we can infer from that over $1.6 trillion of money has disappeared through debt repayment and default, either one. It's functionally the same for the money supply. And why can't the money supply expand now? Well, banks can't find enough people to lend the money to who would take that loan and use it for business because interest rates are too high. So if a bank can't make loans, but it could only get loans repaid, then the money supply shrinks. So the point is that once the reverse repos do run out, there will be no counteracting the actual deflation going on in the monetary system right now. And you'll start to see the money supply really plummet really fast, and it's going to lead to some kind of repocalypse or something similar. Now, here is where the Federal Reserve officials are arguing the point. So the point is here that John Williams of the New York Fed does not believe we are anywhere near close to a problem in the plumbing, and QT should continue as normal at the current pace. You've also got this guy who's also a Federal Reserve governor, Chris Waller, I think his name is, who doesn't think that it even matters what's in the reverse repo facility at all. Take it away, Chris.
Gold appears to have built solid support above $2,000 an ounce, but momentum to move higher in the short term has eased with uncertainty about the timing of Federal Reserve rate cuts. But short-term sentiment aside, there are plenty of reasons to remain bullish on the yellow metal. How do you anticipate ongoing monetary policies affecting gold prices? And what factors will be most influential in the months ahead? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.